welcome. I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide you insights on the markets and planning. So here we are. Today is February 20th, and over the last week, originally the markets were up a little bit up until today. This morning there was one of the Dow stocks that reported, and it really has dragged down at least the Dow sector from last week to this week. Now the Dow Jones is down a little bit now. The S&P 500 and the NASDAQ from last week to this week are up a little bit. That's as of today, but we'll see where the market ends up. Obviously, there's a lot.
Do you have year-to-date numbers?
I do. As of July 19th, the Dow Jones was up.
July?
I'm sorry. I wish I was in July.
I understood what you were saying. I knew you were saying January.
Not January, February. I don't know. We're all mixed up here.
What month are we in?
I don't know what day is it.
You're just looking forward to a vacation, I think.
I guess. So as of February 19th, the Dow Jones was up 4.9%, the S&P 500 4.46%, and the NASDAQ 3.86%. However, today, a lot of those indexes are down over 1.5%, but we'll see where we end up for the day. And then looks like with mortgage rates right now, it's coming in a little under 7%. So we're looking at 6.85 for 30-year mortgages and 6.04 for 15-year mortgages. So those kind of have been pretty steady over the last several weeks. And then there's been kind of talk still about inflation and the Fed and revisiting minutes from January, and looks like there's no urgency on any rate cuts that are headed our way. Looking at kind of where we're at with some interest rates, so if you look at 6-month CDs or treasuries, they're coming in at about 4.35% right now. And the 1% is coming in, 1% CDs and treasuries are coming in at about 4.25.
1 year?
1 year.
1 year.
Yeah. So, and CDs and treasuries, they kind of fluctuate a little bit. I mean, they're slightly off by 0.02% depending on, if you do a CD or a treasury.
Yeah. Yeah, those the rates seem to be having a little bit of an effect on the housing market. People are saying that it has slowed down. I don't know if you've read anything about that, but
considerably. I thought I saw something. They were like new home sales or something down like 10% year over year from where they were, or maybe more. I don't know.
I don't know the percentage. I just know that things are slowing down. And I know in my neighborhood, I'm seeing cuts in prices, which we haven't seen for a long time.
Well, that's what I was going to say. You think it's because prices are so high and people are kind of buckling, tightening up their belt a little bit, so to speak. So that's why it's slowing down, or is it still
I think
inventory?
that's part of it, and I think just that you have interest rates, mortgage rates that are near 7%, and especially those people who had refinanced their mortgages. Although that's starting to wane a little bit, only because people do move, people go places, whatever. But those people that have the 2.5% and 3%,
they don't want to go anywhere. It's like, I don't know.
Think about reasons why to stay, not to move.
I'm going to touch a little bit on your market volatility.
Yep.
And you have to remember that we've had a pretty decent rally from the 1st of January through February. So we're probably getting a basic garden variety pullback. But we're also in February, which, the majority of the S&P stocks have already reported. I think about 80% have reported. The big market-moving stocks have already reported. So now you're getting the secondary and tertiary stocks in the S&P reporting, and they can go up 10 or 20% or down 20%, but they're not moving the markets per se. We're still about 6-7 weeks away from the start of Q1 earnings, so the market starts to look at other things, like you were saying, the Fed, interest rates, CPI, the Consumer Price Index, PPI.
Well, now tariffs.
Tariffs, the whole thing. And also, you start hearing more about trend lines and support levels. And for those who don't know, trend lines are simply price pattern, prices that show up in a pattern on a graph. And support levels are price levels of an asset that typically shouldn't fall below a certain price for a period of time.
So these are technical indicators.
These are technical indicators, but they sometimes will show that there may be a reversal or a reversion coming up. So,
but what my point was, it's not fundamental.
It's technical. It's all technical. So the market
it's price movement.
So the market kind of focuses on that now because earnings season is over. So they're not seeing a lot of the companies talking about their earnings and because they've already given their guidance. But on a lighter side, and I'm not sure if this is true or not. When I worked in New York, we used to always kind of joke around and say, the big New York financial firms would always give out their year-end bonuses in mid-January, which meant that all the senior financial executives and portfolio managers would head down to the Caribbean and leave the junior guys to take care of the shop. So that's why February was always a little bit choppy. But clients are asking me now, what do you do? And I think now is a good time because there's a lull between earnings season. Scrub your portfolio. You know, if you have stocks that have done well and you still like them, hold on to them. If you have stocks that are not doing well relative to peer groups, or if they're down more than 20%, maybe you sell them, revisit them later, or use the cash to go elsewhere. But remember, markets and stocks move up and down very quickly. You don't want to get too conservative because any positive catalyst is going to have an outsized effect and you're going to be chasing momentum. So, you know, scrub your portfolio right now because, again, it's kind of like February is kind of like the Cinderella month. It's kind of.
So it sounds like what you're saying is that, you know, really this is more of an individual thing. You got to look at your portfolio and see if that makes sense for you.
Oh, absolutely. Yeah, because, again, you know, you might have a lot of gains in technology stocks, but you don't want to sell them. And you may have losses in some retail stocks where you say, hey, you know, I'm kicking them out. You know.
Or you might want to take the gains. So it's all individual.
Yeah, I say hold your gains. I always like to keep my winners and sell my losers. So that's my tip.
Yeah. Well, thank you for that. You know, it's interesting. We talk about what's going on right now with consumer sentiment. And according to the CNN Fear and Greed Index as of today, it's at 45, which is just still in the neutral rating, but it's very close to, you know, being fearful. Not quite there yet.
What is that range, the neutral range? Like
it goes from about 45 to 55, something like that. And I don't remember the exact one. I gave you that, I think, a week or two ago, and I don't have it in front of me, but it's pretty close. So and then
we're pulling back. People are starting to get a little more concerned. Maybe.
It seems that way. And you talk about earnings season, although we're not 100% done because there are still companies that are reporting. According to the Wall Street Horizon publication, that as of February 20th of this year, which would be today.
Not July. Just kidding.
Yeah, not July. The first quarter earnings season, it says, has shown robust performance among S&P 500 companies. It says approximately 80% of these companies have reported earnings that surpassed analyst expectations, with an average surprise margin of 7.3%. And this has contributed to an estimated year-over-year earnings growth of 12.7% for the index. So, you know, when you're going up by 7.3% more than what people thought, that's usually something that the market likes. But then there's some other things that are going on, you know, with, for instance, you know, what's going to happen with government workers. You know, I understand that the Trump administration has said that they want to cut 8% out of government.
Well, that's just defense. I think.
Defense,
yeah,
right. But that means layoffs.
Sure.
So, you know, there's a lot of, you know, concurrent trends
so here
going
you
on
have
right now.
the tariffs coming in, and you're talking about higher inflation, but then you have these counter things that are happening. So you kind of wonder, what is this going to look like with the
and a lot of the what Trump's putting in place with the tariffs and everything. You know, some have been delayed. You know, it'll be in March, might be April. You know, he hasn't really talked a lot about tax cuts yet or what's going to happen there. So a lot of stuff is really up in the air at this point.
Yeah, and what you don't want to see is overconfidence.
Yeah.
Right.
Because generally speaking, when you have overconfidence, you have the top of markets. And, you know, I'm not seeing overconfidence, even though there are some places that seem to be saying that the retail investor is overconfident. I don't really see that.
I don't see it either. In fact, I read something where there was a sizable amount of dollars that came out of equity funds in the month of January, and it was mostly from the retail side. I think maybe it was a Schwab report or something, but it was kind of interesting what you said about government workers and, you know, the layoffs coming. It's kind of interesting. Everybody worries about government workers and da-da-da-da, but think about it. There have been so many companies over the past year that have laid off 10 to 15 to 20% of their staff, and the stocks have done incredibly well. So, there is a factor in there that, hey, maybe government was too bloated.
Well, I've been preaching about that for a long time, that, we can't sustain the deficit that we've got and the debt that we have. It's just not sustainable. So, going in and saying we're going to cut a certain percentage, I think is a good thing.
Yeah, I think it is too. I'm a little surprised how much they are avoiding, the two biggest issues, Medicare and Social Security. I thought he would actually try and do something about those, since we're less than 10 years.
Meaning Trump?
Trump, yeah, the Trump administration, or even, and maybe the Doge group, has brought it up, but he's refusing to do it. I don't know, but, it's Medicare, Social Security, and interest payments on that debt that we've accumulated that really need to be addressed, in my mind, over some of these other things.
If you can get rid of the debt, you'll take 1/3 of the budget away. I mean, that's huge, which is why I'm saying that I like that someone is finally saying we need to cut. We need to cut government because it's gotten too big. And then, seriously, when I look at some of the things that we're paying for, that our tax dollars are paying for, it's just complete waste. And I know some people say, well, it's just a drop in the bucket. But still, even if it's a drop, why are we spending money that way?
But when you've got, the interest payments on that debt, you can maybe get that debt down some. You might as well put Medicare and Social Security on the same table, I think, because you can't turn around, you can't get rid of that debt overnight. It's going to take a long time. You can't fire enough people, to really move the needle, in the next 4 years, I don't believe.
Well, you may be right, but Social Security and Medicare are two, third rail type issues. And I don't know how they're going to, you're right in that those cost a lot of money, but then you've got to take it from other places, and that's I think what they're trying to do. Whether they can or not, I don't know, but at least it's a start. I think that anything that says, hey, let's cut some government because we don't need all this government.
Oh, 100%.
But even if we needed it, you got to say, where does the money come from?
Right.
All right. So even if you need it, if you can't pay for it, you could say, hey, I need a yacht, but I can't afford it. It's the same type of thing. Well, what do we need and what can we afford?
Right.
So that's the problem with government in general. People want a lot and you don't want to pay a lot, but they want to get a lot. And, it's
Want
not
your
easy.
cake and eat it too.
Right. I'm glad it's not me who's running it because I don't have the silver bullet answer. But I do think that cutting is an interesting way of going, and I think it makes some sense.
Well, if they do stop all the payments to people over 150 years old, that'll save a little bit of money.
Well, I mean, that's part.
But you're saying it's a drop in the bucket. But
Right.
even so, how many checks have gone out to people that are dead? I don't know.
Right.
And what happens to those checks?
Right. Well, that's the good part about the accountability.
Yeah, that's what I like. I like accountability.
Right.
It's good. I mean, we have it in all of the stocks. I mean, these are publicly traded stocks, and they have their quarterly reports, and so everything is transparent.
Well,
And
if
so
you run a
said-
government like a business, then you do have to cut.
Yeah.
I mean, you said it before. There are companies that there are times when they have to lay off people for whatever the reason is, and generally it makes them more profitable. Now, you may or may not like that, but from this company standpoint, that's how they end up staying in business.
So on another topic, so the Tax Cuts and Jobs Act, which is expected to expire at the end of the year, we have Rachel that will be doing a segment on this at our brunch coming up on Sunday. So we'll ask her next week to give a little update for our podcast. But there was one item that kind of caught my attention, and that is even if the Job Cuts and Job Act doesn't not get extended, it looks like Roth conversions will remain permanent. So just something that's still in place. What's also on the table with that is the elimination of the Roth conversion recharacterization rules, which means undoing some of the conversions that you've done in the year. But we don't see that very often. More often than not, we do get questions on what's a Roth conversion? Should I do it? And I think there's a lot of headlines and articles, and everyone's always saying, do it, do it, do it. But the reality is it is case by case. And just to explain what that is a Roth conversion is basically moving money from your traditional IRA and converting it to a Roth IRA. And when you do that, you're basically paying the taxes on that conversion. So you want to make sure you have that money set aside. And people tend to do that if they think they're going to be in a lower tax bracket, then they will be later when they need to take the money out. So there's some planning that's involved. It does make sense for some, but not for all. It's not a one size fits all, but we are here to kind of talk that through with you individually, case by case.
You know, there was a tidbit that came across here this morning about the truck company Nikola. Apparently, they filed for bankruptcy, so they're out of business. And it's interesting because it's an electric car company, and I wonder if this is the tip of the iceberg for some of these smaller electric car companies.
I said we have one here local here in Carlsbad too.
Well, yeah, but they're more. That's actually.
It's like
it
a
is
motorcycle.
electric. Well,
thing,
yeah, it's a three-wheel car. It's also electric, but their big thing is that they can go like 40 or 45 miles on solar.
Well, I think this Nikola, didn't they have a big issue with fraud? I mean, they had a truck they showed moving, but it was rolling downhill. It didn't even have an engine in it.
Oh, really?
Yeah,
okay.
I was not aware of
I
that.
wasn't aware of
I'm
that
pretty
either.
sure this was about 5-6 years ago. And yeah, Jocelyn's nodding his head. They literally, I was surprised that they're only going BK now. I thought they were already gone.
Well, I think a lot of the EV companies are going to go file Chapter 11. Their EVs, the cars aren't selling, the charging stations aren't being established, and people want to buy gas-powered cars. And
It seems like a lot of hybrid. I think I feel like I'm seeing
hybrids
a lot more.
are okay. Yeah,
I'm seeing a lot more
hybrid
hybrids on
has
the
been
road.
the best-selling
Hybrids
vehicles.
are good sellers.
I think it's a
But-
good transition instead of just going.
Well, there are a lot of people who are buying electric cars.
Yeah.
I mean, as soon as you say nobody's buying them, I don't believe that at all.
I look in our
they're-
parking lot, and I bet it's 20% are Teslas. And there might be some other EVs, but I count the cars. I look out there sometimes like Tesla, Tesla, Tesla. It's like, it's crazy.
Well,
There's a
Ford-
ton of them around here.
And we're not recommending that
We're
stock.
not recommending stock.
No, I'm not
We're
recommending
just saying
that.
the car in general.
They wouldn't announce a $4.8 billion loss on their EV sales if people were buying EVs. So again,
Right.
you've got to look at the car company. And you're right, Steve. People are still buying electric cars, but where are they buying them? Mostly in the the coastal areas, the Sun Belt areas where they have much more, I guess, favorable electricity supplies.
Yeah, my point was just that people still are buying electric cars, but the demand for them has gone down.
Significant.
From what it was just a couple of years ago. And I think you're right. Part of the problem is that the infrastructure for an electric car. We go back to how much electricity do you need or how much fuel, and we just don't have that infrastructure in place just yet.
Yeah, I've got some friends that drive between Phoenix and San Diego, and
You have to plan probably.
the wife will not drive in their very nice high-end electric car because it won't necessarily get here. And one time when they were going back, they're trying to pull into one of those charging stations. All the superchargers were broken or full, and so you're in the ones that were very slow to charge. She's like, never again. So they either fly or drive a gas-powered car.
Yet the people who I talk to who have electric cars, they tell me that they love
Yeah, a
them.
lot of people like them.
Absolutely love them. I've heard almost no one say that they didn't like their car.
For commuting around town, short distances, but if you want to go a couple hundred miles, round trip or one way.
We heard
gotta
another story
plan.
that somebody was traveling from California to Texas, and they had to stop numerous times, and it being a long, enduring trip. So-
Right. The infrastructure's just not there yet to have, the electric car.
Well, we're not going to get into that. But anything else going on this week? Okay, well, we touched on a few different subjects. If you have any questions, give us a holler. And if not, we will talk to you next week. Thanks for listening.
Thank you.
Thanks.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.